Hi everyone, welcome back to Atrium Research's YouTube channel. Today I have the pleasure of interviewing Aurora Davidson, the CEO of Amerigo Resources, which trades under the symbol ARG on the TSX. We cover Amerigo with research coverage and have a buy rating and a target price of $6.50 per share on the company, which we increased this morning on the back of the Q4 production results. Amerigo, just as a quick high-level intro, is a copper producer which processes fresh and historical tailings from Codelco's El Teniente mine in Chile and has a well-defined unique capital return, and unique capital return strategy, which Aurora will talk about a little bit on this call today. So Aurora, with that, thanks for you being here.
Thank you, Ben. I appreciate the opportunity of talking with us so quickly after we issued our operational results for 2025 and our guidance for 2026.
Of course, and we'll dive into those in a little bit here, but the stock has been doing fantastic. It seems to be hitting all-time highs almost every day, including today. So congrats on another great quarter and full year 25. But for investors who don't know the story too well and aren't completely up to date, maybe you can walk us through a brief overview of the company, its operations, its business model, and then we'll get into some more specific questions after that.
Sure. Let's start with that, Ben. So Amerigo is a Canadian company trading on the TSX that has a unique business model in the copper industry. We operate in Chile through an operation called MVC, where we process tailings, which is essentially the waste material from the mining process. And we process the tailings from the world's largest underground copper mine, El Teniente, which is owned by Codelco, Chile's national copper producer. MVC, interestingly, has been processing these tailings from El Teniente since 1992 without any interruption. So instead of traditional mining where copper is recovered from ore, we recover copper and molybdenum from tailings. Working with tailings significantly reduces our mining risks as our operations are focused on what's called the concentrator plant, which is the most quote unquote industrial part of the copper production process. We have a very simple business model, which is built on a long-term agreement with El Teniente that grants us the right to process their tailings and to produce copper and moly concentrates, which we sell at market prices. After we process the tailings, we return the tailings to them. They are their tailings from beginning to end. And as consideration for allowing us to process their tailings, we pay them royalties on the copper and the moly production. And given that MVC already has the capacity to process all of the fresh tailings produced by the El Teniente mine on a daily basis, we do not require further capex. We do not require capex expansion, which is very capital intensive. So that puts us in the unique position in the copper sector of being able to return capital to our shareholders through what we call our CRS, which is our capital return strategy, Ben.
Great. No, thank you for that. And maybe just quickly, you can touch on the actual fundamentals of how you receive the tailings from El Teniente and then how you give it back to them, because it is a pretty efficient process. I've been to site, I understand how it works, but for the listeners, maybe you can just explain that.
Yes, it is very efficient and it presents a series of advantages and also a series of constraints at the same time. So you have to think of three different points in a chain. We have the El Teniente mine up in the Andes Mountain at a higher altitude. And then we have coming downstream sort of midway into this circuit that I'm trying to describe, we have the MVC plant. And then further down from the MVC plant, we have the tailings deposit where the current tailings of El Teniente are being deposited, which is called Karen. So if MVC didn't exist, the mine would just be sending all of their tailings down through a channel, a concrete channel, to their tailings deposit. What happens in this case is that we have MVC in the middle of that circuit as a bypass operation where the tailings that are coming from the mine are diverted temporarily into the MVC plant for the processing of those tailings, and then they are returned down to Karen. So this is a significant advantage of our process in the sense that we do not have to incur any transportation costs from to move those tailings into the MVC facility. They're coming by gravity.
Mm-hmm. Mm-hmm. And again, you're able to keep your costs quite low despite processing such low grade copper, and we'll get into that. But maybe looking back at 2025, coming out with the full year production results this morning, could you just touch on the copper production, molybdenum production, and maybe costs compared to your initial guidance, and then the variances in between and what sort of drove that?
Sure. Well, let's start with the headline news. Amerigo delivered solid operational results in 2025. Our copper production was 62.2 million pounds, which exceeded our revised guidance of 60 to 61.5 million pounds, which was issued on October 8 of 2025 after an accident at El Teniente that had an impact on the volume of fresh tailings that are sent by El Teniente to MVC. So at the end of the day, the production results were 1% above the revised guidance or 1% below the original guidance. So they were positive, however you want to look at them. In terms of the moly production, it was 1.5 million pounds and it exceeded our guidance, which was 1.3 million pounds. In terms of cash cost, our normalized cash cost for the year was $1.87 per pound, which outperformed the guidance we had provided, the original guidance we had provided, which was $1.93 per pound. Other operational metrics for 2025 worth mentioning included our plant availability, which was 98.4%, and the fact that MVC operated with no lost time accidents and no environmental incidents during the year.
Amazing. And yeah, considering the shutdown up at El Teniente, I think what you guys were able to achieve, I think it speaks to the business model having two different sources of ore, if you want to call it that, or tailings, certainly de-risks your reliance on, any issues that may arise like it did in 2025. And kudos to you guys to be able to minimize that impact. Maybe on the 2026 guidance, you can just talk about what that looks like compared to 2025, and what investors can look forward to this coming year.
Absolutely. So as you mentioned, we also have released today our production and cash cost guidance for 2026. So let's just walk your listeners through that. So in 2026, Amerigo expects to produce 63.8 million pounds of copper and 1.5 million pounds of moly. This marks the sixth year of increased production guidance that we have provided. These numbers, the production numbers, are the building blocks for our operational and financial plan for the year. So let's discuss a little bit of the economic parameters that we have used for our budget, because I think those are important. There's a reasoning behind those numbers. Just a word of caution, Amerigo will always use a conservative copper price to prepare the annual budget. That's the way in which we embed a level of discipline into our operational metrics and performance as an internal team. So for 2026, we are using an average copper price of $4.80 per pound. Compared to today's LME spot copper price, which is $6.04 per pound, this is a conservative number. So that's the warning that I want to provide. The other economic parameters that we have used in our budget guidance are a moly price of $21 per pound, which is very close to market, and a Chilean peso to US dollar exchange rate of 900 pesos. So if you put all of these assumptions, the production assumptions and the economic assumptions together, we expect to have an annual cash cost of $1.98 per pound, which is slightly higher than in 2025 as a result of what we anticipate will be a stronger performance of the Chilean peso against the US dollar this year. We also have factored in higher energy pass-through charges to the Chilean industrial consumers, some higher reagent costs. We have worked with minor but still real inflationary adjustments to our service contracts. And we project to have higher environmental compliance costs and higher historical tailings extraction costs. On the positive side, however, our 2026 cash costs will benefit from current record low treatment and refinery charges. So moving on to what that translates to in terms of financial results, the production and cost projections give us a projected 2026 EBITDA of $74.5 million, excluding the effect of the 2025 settlement adjustments. As you know, we sell our copper on an M+3 basis, so we have an exposure of 3 months from the time of delivery to the time of final settlement. In a period of rising copper prices, as what we're seeing, there will be positive settlement adjustments, but we try to exclude those when presenting our annual EBITDA guidance in order to deliver the purest annual view possible and not tainted with, in this case, what would be the favorable impact of your prior year settlement adjustments. Let me talk a little bit about the CapEx now for 2026. We are projecting to have a higher than normal CapEx of $17.5 million, and there's a reason for that. First of all, we have $2 million in projects that were in CapEx projects that were initiated in 2025 that will be completed in the first quarter of this year. That's just a timing difference, but we do have this rollover of $2 million into 2026. And we have therefore a CapEx of $17.5 million, and we have 3 buckets. We have optimization projects of $6.4 million, and we can talk about those if you want. We have sustaining CapEx of $5.5 to keep our operations in tip-top condition and ensure operational continuity. And we have $5.6 million associated with our annual plant maintenance shutdown and with strategic spares. So the last 2 buckets are just to keep things working as well as they worked in 2025. All of that requires investment. And the optimization projects obviously have a reason of existing. We can discuss that, but those are also carried out in response to the high copper price environment that we're seeing. And finally, on the guidance, let's discuss free cash flow. The free cash flow that is expected to be generated in 2026 under the guidance is $34.8 million, again excluding the effect of the 2025 settlement adjustments.
Amazing. Thank you, Aurora. You sort of answered a couple of my questions within that, but I did just want to go back to the cash costs because, you were saying it's increasing because of X, Y, and Z. But just for some context for the listeners, this is rising from $1.93 in 2025 to $1.98 per pound. So a very small increase, right? This isn't a dramatic increase, and inflation oftentimes is much higher than that roughly 2% or so, or whatever that maths out to. So I did just want to highlight that. And then on the CapEx. With regards to these optimization projects, I'm aware that you did work on a couple initiatives over the last year and a half to optimize the operation. So maybe you can touch on the previous ones, the impact that those had, and then what you might be looking into in 2026, so that people can sort of see the impact that those previous initiatives had on the 2025 numbers.
Yeah,
or maybe even Q4.
For sure. And I think it's important also just to talk a little bit about CapEx and explain why we're looking at them at this optimization CapEx. because I mentioned before, we are not in growth mode. However, we are keen to identify optimization capex that can benefit MVC in two ways, either through higher production or by reducing costs. When we look at optimization capex, Ben, we need to ensure that projects don't compete against the CRS and ultimately support it, and that these projects become generators of higher free cash flow in future periods. So we're not just undertaking optimization projects because the production manager thought that it was cool to do X or Z project. We always see them as generators of higher free cash flow in the future. So needless to say, we conduct a very extensive cost-benefit analysis of potential optimization projects. Not all of them make it to the finals. Only those that make total technical and economic sense are approved. So looking specifically into 2025, MVC had an approved capex budget of 4.1 million for optimization projects, and we had three major initiatives. We wanted to work on the optimization of regrinding classification that was completed in September of 2025. We wanted to work on optimization of the Cascades flotation stage, which was completed in November of 2025. And we also wanted to work on the optimization of the concentrate sedimentation stage, which is a project that will be commissioned in March of 2026. Because we needed to do some final tweaking and buy some additional components in order to complete it according to the best completion way possible. So the overall objectives of these three optimization projects were to increase our process stability, which leads to higher recovery rates. And I know that some readers or some listeners would want some more tangible information. So for example, the first project, which was the optimization of the regrinding classification. In this project, we achieved a 4% increase in recovery rates in the cleaning stage of the concentrator, and also reduced particle size variability, which increased the release of fine material. Once this was achieved, we saw that this was not only benefiting the copper circuit, but also the recoveries in the moly circuit. And it was one of the reasons why we exceeded our production guidance for moly in 2025. In fact, the 2025 completed projects, all of them exceeded their expected contributions. And we're building upon these results to continue with projects along the same lines in 2026. For 2026, if I have a minute, I want to talk about our optimization capex, which is, as I mentioned before, 6.4 million. This is a higher dollar number than usual for good reason. The projects have very attractive paybacks using our budget copper price of $4.80 per pound. And we have, again, three major projects. They include improvements to our pumping capacity and stability. This project has a payback of 1.9 years. We will continue working on the optimization of the Cascade stage, building up on what we have already achieved in 2025. This project has a payback of 0.7 years. And we're working also on optimization of the rougher flotation concentrate transport and recovery in the cleaning stage, which has a payback of 3 months. So those are our optimization projects for 2024 and 25 and 26.
Amazing. I want to touch on the 2026 optimization projects in a second, but just going back, you mentioned that part of the reason why Amerigo beat on the Q4 numbers with regards to moly, or the annual numbers, despite these projects only being completed in, I believe you said September and November for 2 out of the 3. So that being, built on a full year in 2026, I would imagine could have improvements as well, and that should be baked into the 2026 guidance as we just discussed.
Correct.
But on these other projects that you just mentioned in 2026, those payback years are very short, or that those payback periods. So I
Mhm.
think investors, when they're looking at $6.4 million, you guys are seeing quite a material impact within the year. And I imagine you'll talk about this in the future, but I don't think that that should go unnoticed for 2026 and beyond. And I think, as you mentioned earlier, with copper prices continuing to rise, there's different initiatives that you can work on to further optimize the operation. Um, so I appreciate that. Thank you for walking us through that. Um, was there anything else that you wanted to touch on operationally before we get into the CRS model?
No, I think that there's nothing else or nothing new to disclose. Just, if I can take the opportunity to congratulate our team at MVC. They are an exceptional team with a keen focus on operational excellence, operational continuity, and that translates as well into the financial results that we see quarter on quarter. So I'm really proud of the team in Chile.
Hmm. Absolutely. And I've been down there, and I think one of the cleanest, most well-organized operations that I've been to. So kudos to you and the team down there. But then I guess operations aside, all of this trickle downs to being this cash flowing machine that Amerigo is. Can you touch on the capital return strategy, maybe from a bird's eye view, what that strategy looks like, why it's been put together, and then we can talk about maybe the impacts of these rising copper prices and such after you explain that.
Sure. I appreciate the comment from a bird's eye view. Maybe I speak a lot about the CRS, but I think there's a reason for that. It's a unique model, Ben. I think that the capital return strategy that Amerigo rolled out in 2021 has worked tremendously well for the company, obviously, and for its shareholders because it captures or it provides us with the mechanisms to return capital to shareholders in three different ways. We have quarterly dividends, we have performance dividends, and we have share buybacks. And we have been active on the three, and the three are different, but they are complementary. The building block of the capital return strategy is the quarterly dividend, which started at 2 cents Canadian per quarter and has been increased at the end of last year to 4 cents Canadian per quarter. We want that quarterly dividend to be a secure dividend stream and an income stream for our shareholders, and we've managed to do that. Even if the copper price will always have cyclicality from quarter to quarter, that base dividend has been established and has now been revised 4 cents Canadian per quarter on the basis of us not ever having to cut that dividend down. And then that gives us a room when copper prices behave in the way they have been behaving, particularly in the last 3 months, to do additional distributions to shareholders. And we've worked very hard on share buybacks, retiring a significant amount of shares in the last almost more than 4 years. And then we have the performance dividend, which is a dividend that works really well when copper prices are rising, and we can capture additional free cash flow on the settlement of our production, which is priced, as I mentioned before, 3 months in arrears from a copper price perspective. So, for example, the December performance dividend, specifically speaking about that one, it was triggered because we moved from a copper price of $4.51 per pound in September to a copper price of $4.90 in November. So there, on it in itself, you have a 40 cent per pound appreciation of 3 months of production that generates substantial additional cash flow. In a perfect world, that dividend would have been declared and paid in December, but there are some days, there's some leeway that has to be followed between the declaration date, the record date, and the payment date, and it just couldn't be fitted into December. But that's the genesis of what happens with a performance dividend and how it's triggered. So we've since seen even a stronger performance of the copper prices. I mentioned $4.90 in November, and today's copper price, spot copper price, is $6.04 per pound. So there you have it, bird's eye view of the CRS.
Yes, well, no, and I appreciate that, and I think, what I'll highlight is just having these different levers to pull, right? And you look at the cost benefit analysis to doing any which one, and you assess what's best for the shareholders. You guys are shareholders, and then you make that decision. And so I think investors can be confident that this model has already proven to work, and it's going to continue to work in this rising copper price environment. Um, Maybe just mention the the debt being fully paid off back in Q4. I know we spoke about this already, but um, I think that was a material initiative in 2025 you guys um, that you guys were successful in paying down, and the impact that can have on free cash flows. Again, this is built into the guidance for 2026, but it's going to be a noticeable difference from 2025 to 2026.
Yes, and the initial benefit to shareholders from that debt reduction was obviously the increase in the quarterly dividend by 33% in October of last year.
Um, and we'll talk about I want to talk about the copper price a little bit more because it has risen dramatically over the last couple months. But before we do, um, excuse me, the um, excuse me, I got lost on where I was in my notes. But yes, I guess let's dive into the copper market as it stands. So I know you have some opinions on this. Amerigo is one of the better ways to, get exposure to copper and that whole market, which we believe is going to be around for some time. So maybe you can touch on the copper price, and then I'd like you to just explain to the investors on how you guys are using the LME copper price, which might have actually been detrimental to you in 2025 when there was a little bit of a delta between the COMEX pricing, and then now it has swung in your favor. So maybe you can touch on both of that for us.
Well, let me just clarify. We don't use the LME as if it was a matter of choice of the company. We sell our copper
Mhm.
concentrates under LME pricing, which is basically the benchmark for most of the copper sales in the world. Long-term copper contracts are priced at LME copper prices. The COMEX is an exception, mostly driven by North American contracts, which are not our purview, and
Correct.
for futures copper market. But the traditional copper concentrates in the world are sold through the LME, so it's not a today we're going to be choosing LME or COPEX or COMEX. That's not the way it happens, but just wanted to
Hmm.
clarify that. So my views on copper, well, we're seeing obviously record copper prices. That is a fact. Today's LME spot price is $6.04 per pound, as I mentioned before. So interesting enough, yesterday I was reading a very thorough and a very deep Substack article that provided some very interesting views on the 2026 outlook for copper, calling it not just a bull market, but also something deeper than that. They called 2026 would be a regime shift in copper. So that may sound a little bit dramatic, but they did make some very good points that I'm going to bring into our conversation now, because I've spoken about
Hmm.
some of those points before on our earnings calls. So in a traditional economic analysis, the assumption when you have a high commodity price such as copper right now is that the high copper price will incentivize mine development, will bring in new copper production, the market will rebalance with that new influx of supply, and copper prices will fall. Correct? Um,
Right.
what this article was mentioning is that may not be happening for three reasons, and I have spoken regularly about at least two of them on Amerigo's earnings calls for years now. Number one is that mined copper production has been affected by declining ore grades for decades now. This is a geological constraint. It is faced by major copper producers who used to mine very high-grade deposits, and this cannot be solved by higher copper prices. The supply of copper cannot be fabricated. It is driven by copper grades, and copper grades are falling. So that's point number
Yep.
one. The second point is that it takes a long time to bring a mine into production. Years ago, decades ago, it used to be 6 years. But now it's almost 20 years. I think it's 18 years right now. So even if new deposits are found, which will most likely be lower grade deposits than what we are used to speaking about, those deposits will not become a mine and will not bring in new copper concentrate into the system anytime soon. So those are two factors that I've mentioned in our earnings calls for many years now. But there is a third factor which is new to 2026, and that is that for the first time ever, the annual benchmark for treatment and refinery charges has been set at zero. Treatment and refinery charges, or TCRCs as we call them in the industry, are the fees that miners pay the smelters to process copper concentrate into copper cathode. And when concentrates are scarce, as they are now, TCRCs fall because the miners are in control, not the smelters. The smelters are asking for concentrate, and there is no more concentrate to allocate. So in 2026, the annual benchmark, which covers long-term contracts, has been set at zero, which was never thought of before. That speaks about the extreme scarcity of concentrates. And this is a new driver in the market because it could have a series of triggering effects, smelter shutdowns, for example, lack of production of the copper in the semi-unfinished ways that make it usable. No one uses copper concentrate. It's a black powder that cannot be used anywhere. You have to process it in order to produce the fabricated materials that are used in industry, etc. So if smelters start shutting down, inventories are going to be affected right away, and we don't have that much of inventories holding ground, etc. So this speaks about a structural shift in the market, which, if you analyze these factors, could indicate that we have a very good chance of remaining in strong territory, copper price wise, not just temporarily, but for a long time. That's one interesting view. And you also asked me how does Amerigo fit into this picture, and I think that just to perhaps close on the chat now, because I've overused your time, Amerigo offers
No.
a unique way of gaining exposure to copper prices because our entire business model is built around copper production of concentrates, right? We don't face the same capital intensity requirements or permitting risks associated with new mine development. We have a long-term contract. Operations have been ongoing since 1992. So we're stable, long life, and directly linked to copper price movements, meaning that when copper prices rise, our margins and our cash flow expand significantly, as can be shown by our guidance and our guidance sensitivity. So, we have fully repaid our debt. We have a disciplined capital return strategy. We know that all of these factors together mean that higher copper prices translate into stronger free cash flow, which we return to shareholders through the CRS. So I don't think that there's anything else to explain there. Amerigo is a long-term, well-oiled, disciplined compounding machine.
Well, I appreciate that wrap up. That was great, Aurora, and it did put a sort of a cap on things. But just before we wrap up, the question
Okay.
that I missed there previously, or not even necessarily question, but something that you noted in the press release from this morning, which was that for every 20-cent per pound increase in the copper price, it could have an average based on the current projections in Amerigo's models, an EBITDA increase of $4.2 million. So
Correct.
that's a huge number for a fifth of a dollar when the copper price is already trading more than a dollar ahead of the guidance and the projections in your copper prices that you've put together for 2026, which is $4.80 per pound.
I always call our first news release of the year the most important one. For shareholders, I would print it out and have it, nearby so that I could refer to it and guide me through the year. Because as you mentioned, Ben, our sensitivities are quite significant, and we try to explain them in the guide in the news release as best we can. So yes, you mentioned for every 20 cents per pound increase in copper price, there's a $4.8 million change in EBITDA, but there's also a $4.1 million change in free cash flow.
Right, exactly. Sorry, I misspoke on the number there. But yeah, again, which is massive. So I think investors can see that and be quite happy with where you guys are today, with where copper is today. And then, the points that you just mentioned on the copper price, I do agree. This isn't something like a tech company where they can just bring on supply with the click of a button. It takes many years, if not decades, and we could be in this situation for quite some time. Not to mention that being compounded by the world electrifying itself more and more, battery vehicles, EVs, so on and so forth. So certainly a great place to be in with Amerigo, and investors as of late have been rewarded quite significantly. So hopefully there's more to come in 2026 for you, Aurora. Appreciate you hopping on and walking us through the 2025 results there, as well as the look through into 2026. Best of luck, and keep doing what you're doing.
Thank you so much, Ben. Looking forward to chatting again later on in the year.
Great. Thank you.